Hello, everyone. Welcome to episode number 1 of Straight into Options. I'm your host, Swing Pony, and I am accompanied with the other lovely host, Drippy Too Hard.
Hey, everyone. Welcome.
So, Drippy and I have put forward a very bold task for ourselves to cover options for dummies on the first episode. Now, we want to be clear, this is not something that can be covered perfectly in 30 minutes, but we wanted to simplify the concepts as much as possible for anyone that's new to options or that's interested in learning.
Yeah, by no means this is an in-depth guide. You won't be a successful trader just listening to this 30-minute episode. But what we will offer is enough information to kind of get you started and motivate you to look online and follow along with us in this journey.
Absolutely. Like when I first started trading options, I can't tell you, actually, before I started, how many times I would research them and try to understand them, and the terminology was just not getting to my brain. I would get so overwhelmed researching it that I just couldn't get started. And so part of our goal here is to break down some of the basics and some of the foundation so you don't get overwhelmed into trying to get into all the Greeks at once or all the terminology and giving up. We're going to start with what you need to know, and then we're going to rock and roll from there. Just layer it on one bit at a time.
Right. And before we proceed, we are assuming that you have some basic idea about options, for example. Sorry, not options. I mean, stock market, for example. What is being bullish means and what is being bearish means. So we'll use these terms. And if you are not aware of these terms, it's just a Google search away.
You know what's so funny about you saying that is I distinctly remember when I first started and I had no idea even what those terms meant. It feels like a
Yeah.
lifetime ago, but we all start somewhere, and the more you familiarize, the more it comes to you. So, to kick this off, I want to start with the definition of options. An option is a contract that gives you the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. Again, one of those definitions, it's a little overwhelming. What are you talking about? But really, one of the ways to simplify this is, when you're looking at an underlying stock, are you bullish or are you bearish? So this will lead us into the two different types of options contracts. Trippy, you want to dive into the good old calls and puts?
Oh yeah, I love them. Yeah, as she mentioned, right? If you think that the stock is going to go up in near future, one of the things you can do is buy calls. And what does that mean? It's buy a call contract is in an option chain. There are two types of contracts. There's call contract and there's a put contract. And then next thing you need to be aware of is that if you are in the calls, as the price go up, the value of your contract will increase. So let's say that you paid $1, for example, for a SPY out of money call, 440 call, for example, and this SPY was 435. And if the SPY goes up, the percent increases, the call premium will increase. Now the great part about options is that they are leveraged. So if the stock goes 2% up, the calls might be up 100%, and they might be up 50%. And it depends on what expiration and strike price you chose, which we'll cover in a little bit time. But yeah, so in essence, if you think the stock is going up, then you buy a call. And if you think the stock is going to go down, you can buy a put.
And, one of the corny ways that I had to get myself to memorize this very basic foundation was you pick up the phone to take a call and you put it down to hang up. So calls
Yeah.
up, puts down. Drippy actually mentioned one of my absolute favorite things about trading options, because I'm a former small caps trader who was always trading commons. I had a smaller account. I liked stocks that were $2. Anything more than like 10 felt like a lot to me at the time. But the beauty of options is that because they are leveraged, because one contract represents 100 shares, what you can do is you can actually gain exposure to the big board names. Like you can play Microsoft, you can play Nvidia, you know, bigger names that you normally wouldn't be able to purchase shares of if you have, you know, a smaller account. With options, you can actually gain exposure and, you know, take part of that bigger part of the market that you might otherwise not be able to participate in. And this can be super lucrative also because, you know, with options, you don't necessarily have to put as much capital forward to get bigger percentage gains back. So, you know, I remember when I was trading small caps, if I got, you know, a 30% move, that was huge. That was a lot of money. And Drippy, I know you know this because you've got your Rippas and your Poopas and you know, with options, the way the premiums move are actually very extreme because of the leverage. So it is not uncommon to get 30%, to get 50%, to get 100%. It's important to manage expectations, but with options, you can see a much bigger percentage move based on the movement of the underlying stock.
Yeah, absolutely. A lot of people, like they only think about the positive aspects of options. For example, oh yeah, if the stock goes up 2%, I'm going to make 50%, right?
Mm-hmm.
And if the stock goes down 1%, you'll most probably lose 50% as well,
Mm-hmm.
depending on.
And you know, on that note, there's the thing with options is there's so many different factors that come into play that affect, you know, sort of the gains or the losses that you see based on the underlying movement. So this is something that Drippy I want to dive into next is two of the important things that you have to consider when you are purchasing a contract. So we already discussed calls, we're bullish, we think it's going up. Puts, we're bearish, we think it's going down. But now we have to define this a little bit further. So we need to look at the strike price, and then we also need to choose an expiration. So let's dive into that a little bit.
Right. So what you're referring to, these things, like if someone is just starting out, right, you don't even know where to look for this information. There are a couple of places, if you have a broker, for example, Webull mobile app, you can go to a chart, for example, type Upstart UPST. It will show you the chart. Right next to the chart, there is the options tab. So that way you can reach and see what options mean. So what you will see is it's called option chain. And option chain is basically nothing complicated. It's simple. It just have basics of it has a strike price, and it has an expiration. And so what does it mean? It means that strike price is like, this is the price you think the stock will go towards. For example, if SPY is at 440 and you think that SPY will go to 442. So there are two things there. You think that you're bullish, so you'll buy a call, right? And the next thing you need to know is, you know, which expiration to choose. And that's where you need to know that if what kind of trader you are and when do you anticipate the move to happen. So for example, if you're a swing trader and you think this will happen in 3 or 4 weeks, then you buy the expiration, which, you buy a little bit more time, you buy 3 or 4 weeks. And if you are a day trader and you're just looking to, you think there's a short-term upside, you will just buy weekly contracts or next available expiration. Now, the only difference between these two is there are a lot of differences, but for all purposes with respect to trading, the main difference is that these premiums for the options, which are further, expirations, are super expensive, more expensive than the cheaper ones, than the weeklies. And why this is, we'll cover that in future episodes. But just know that, if you're buying a lot of time, which we're buying, like let's say 1 year expiration, then you would have to pay higher premium. And so it
And
just
you're
depends.
essentially paying to have time on your side.
Mm-hmm.
So we all know that the market can be really unpredictable. I know just recently we were, you know, looking pretty bearish. We had a big downtrend, and then remember we had like 10 straight green days. Like Apple went full on vertical for almost 10 days.
Right.
So this is when you're buying time, you are allowing for these market anomalies to sort of exist without completely destroying the premium and the value that your options contract has. Because when you have more time, things like consolidation aren't going to hurt you as much. The ups and downs of the stock market, if the move doesn't happen immediately, it's not going to hurt you as much. So you are paying to have more time, and that sort of allows you to be what's the right way to put it, a little less affected if the play doesn't immediately go in the direction that you're anticipating. And I'll tell you what,
Absolutely.
when I first started trading, I was all about the weeklies and the zero DTEs. And one thing you will have to know when you start trading options is you will experience some beginner's luck with bad practices. And then eventually you'll start to learn, why it can be helpful to have a little bit more time on your side.
Yes, if you are a beginner, I think you should treat weekly expirations, which means that the nearest expiration super super carefully.
Mm-hmm.
And another thing which kind of determines the price of the option premium is the strike price. And just in brief, like if you're, let's say that options is expiring in a day, for example, and you are buying something which is very out of money call or put, and the price would be very very cheap because the probability of that happening is very low. So another thing which keeps your premium price and defines the price of the option is that. So now you can use these things to leverage your trades and structure your trades in a way. If you think, for example, tomorrow, um, because of the current news, Twitter is going to break out or break down, and you think there will be a lot of people selling Twitter shares, then you can buy out of money puts, and you can pay a very cheap price for those puts, and you don't have to rely on actually shorting the share. You can make money on the downside, and if you're a shareholder, you can protect your capital using puts as a tool.
Yeah, and that's one of the really great things that you bring up, because you don't have to be a full-time options trader to utilize options, right? One of the best ways to actually utilize options is, you might be an investor, you might be more of a long-term holder. And so, if the market is going down, but you don't want to sell off your position because you're playing the long game, this is an opportunity to maybe purchase some puts. I anticipate the price of my long-term position, the stock that I'm holding, to continue to go down, but I don't want to give up my long-term position. So I'm actually going to make some money off of the downside as well. And that is arguably one of the best things about options, is that you can play the upside and the downside. And I remember when I was trading small caps and we had that severe drought where everyone was waiting for the IWM to break out and it just did not. I, was really amazed when I finally discovered options and realized, okay, I can actually do something while the market is going down. I don't only need the market to go up for me to be in favor and to make money. And that was absolutely a game changer for me. Wouldn't you say
Yeah.
that, Drippy? The moment you realize you can play both sides, like that aha moment is just incredible.
Yes, yes. And another pro tip for you guys, if you are unable to buy puts, I know some people hesitate because they always think market will go up, or they just hesitate because they have never bought the puts. For some reason, retailers are scared of buying puts. Um, and being a mentor for some time, the best tip I can give is just invert the chart. Think
I love
about you're
that.
buying the call and just buy a put instead of buying a call. Invert the chart, and I think that will resolve your the mental barrier to buy a put. And puts make money as well as calls make money. And this is a misconception that like puts don't make money. Both will make money.
Well, on that note, staircase up, elevator down. So anyone
Mm-hmm.
who doesn't believe in puts making money, I challenge you to think about that. Because sometimes the downfall goes by so much faster. And I've actually even played calls and puts on the same day with the same play. So that's what
Mm-hmm.
really allows you to be more dynamic as an options trader.
Yeah, I agree. I think most of us are, intraday traders. What that means is we just buy the contract uh, in during the market open or sometime after market open, and then we sell it back, just getting and collecting the premium from the move. And this is essentially a lot of traders do. What a lot of traders do, and
Well, yeah, and
options.
actually, you mentioning that is important because when you are trading options, you do also have the ability to exercise your right, like we mentioned earlier, to actually purchase the 100 shares of a stock. So let's say Twitter is $45 right now. I buy $50 calls. And once I'm in the money, that means my strike price has reached the actual price of the underlying. Let's say Twitter goes to 55, but my calls are for a $50 strike price. I can now purchase 100 Twitter shares at $50 a share. So that would be exercising your right. And while you can do that, there's actually a smaller percentage of people that do. A lot of people are just trading off of the premium. I know that's what Drippy and I mostly do. And this was actually a statistic that I saw on Investopedia. And so it says that only about 10% of options are actually exercised. 16% are 60% are traded, and then 30% expire worthless. So a ton of options are simply just traded for their premiums. And then, we have a 30% which expire worthless, which is absolutely cringe. And that's a whole other conversation if you don't know what that means. But we'll definitely get into that more and more when we talk about, some of the drawbacks of options trading and some of the things that are different than trading commons.
Yeah, and apart from just like these strike price and expiration, there are some other things, which matter a lot for stocks. Um, and some of the things which we'll cover in future episodes include, like the gamma, the delta, the Greeks, and
Mm-hmm.
what does it mean with respect to bullishness and bearishness, and how can we leverage these to collect money from the market. But for today, I think my focus and yours as well is to, how to help people determine the strike prices, right? Like, for example, what do terms like at the money, in the money, and out of money mean? So could you cover that, like, for us?
Yeah.
Mm-hmm.
Yeah. So in the money means that the strike price has been surpassed by the current underlying stock price. So, like I said, I think Twitter is actually at $45 right now, and we'll continue with Twitter because it's a hot name with all the ruckus that Elon Musk is out there creating, trying to do the takeover.
That's a
So
topic we need to talk
that
about
is
it.
that is a whole podcast episode in itself. But that man has the world at his in his palm. I mean, I have never seen someone be such an absolute businessman boss and like an absolute troll at the same time. It's fascinating.
Yeah, it is.
Um, but in the money, so if I buy, Twitter calls for $45 and Twitter's underlying right now is like 45.05, I'm buying in the money calls. So this means that my stock is going to be more expensive, my call option, because it already has intrinsic value. Now, an out of the money option, on the other hand, is if I buy, Twitter calls for $50. So that price has not been met in the underlying yet. So this stock has no intrinsic value, which is something we'll dive into later on future episodes. But that explains why in the money is more expensive and out of the money is less expensive because it's also a matter of probabilities, right? So $45, we're already at that price in the underlining. The, you know, we don't have to talk about the probability because we're already at that price point. But when we're talking about out of the money, who knows if Twitter is going to hit $50? The probability of that happening is going to be less than the option that is in the money. So that's why it's going to be cheaper. Which, Drippy, is something that I would actually love to discuss, because one of my biggest things as an option trader was, okay, do I go in the money? Do I go out the money? What is the risk? What is the reward based on strike and expiration? Do you have any like rules of thumb that you like to use there?
Yeah, I do have a couple rules I try to like stick by. As for example, um, if you're buying weekly contracts and they're expiring tomorrow or within 3 or 4 days, I don't put a lot of size on them, especially because they can go against you so fast. And a small movement on stock price, even if you are right, you can be wrong with options on especially weekly ones, because you might be bullish on Tesla, and you got options expiring this week, and you bought $50 out of money, and you paid a premium price of, for example, $10, and tomorrow Tesla goes down 5% or 2%, just normal market activity, and your premiums are down 70%, and you probably got stopped out. Or if you were holding it, maybe you didn't get stopped out, but you're in a loss right now, and you sell it, and next thing you know, tomorrow Tesla rips, and then it continues. And if you bought them cheaper, you would have held them. So very, very important to understand that the entry matters so much for weekly options. And if you're like a breakout trader, be very, very careful with buying higher premiums. Another important tip I always keep in mind is that I don't buy weekly options when market opens. For example, first 30 minutes, the IV, which we'll talk about in future episodes, the implied volatility in the market is high, so the option premiums are expensive, and you end up paying a higher premium price. And even if the stock, let's say, just pulls back, and you were right about it that it's going to go up, but your premium prices will be cut in half. And next thing like even if the stock rips higher, your premiums are still the same price, because because of the IV. And so these are the things, just like small little things. Don't buy during market open. Just wait for things to settle down. And if you were in the call or put, let's say you are um, you're hoping for a big move to come, and a stock is a slow mover, for example AT&T, you should not buy a weekly call on that,
No.
because the premiums will expire worthless. You should buy more time. So you need to know what kind of stock it is, how much, when is the move you're anticipating is going to happen, and that will guide you. And if you're a beginner, always, always, always buy time.
Always buy time.
Buy less contracts, but buy more time. So this helps you with two things. First, you pay less fee because you're only buying a small amount of contracts, because the contract price would be higher. And next thing is that you will avoid like disasters, an account to be blown just because of the things I mentioned earlier.
Mm-hmm. One of the biggest options mistakes that I made for a while when I started out was I kept trying to swing weeklies,
Mm-hmm.
instead of day trade them. So, it might be one thing if you hold on to a weekly overnight, if it's earlier in the week on a Monday. But to make a habit of buying weeklies and expecting a big move within the same week, I cannot tell you how much money I spent on fire doing that.
Yeah.
And it's sort of like an options rite of passage, right? Jerby, I don't know if you did that yourself, but I definitely, I didn't listen to anyone. I was like, best practices, what? Like, I'm going to do it my way. And, I had a little bit of beginner's luck, but then there was a lot that I learned through trial and error. In terms of options, a lot of it does come down to, do you think it's going to go up bullish, buy calls? Is it going to go down? Puts, bearish, but unfortunately with options, there are other variables that we're going to talk about in future episodes, like the theta, like the delta, like the IV, that, as Drippy mentioned, just because the stock price goes up doesn't mean necessarily that the movement in your premium is going to be linear. So there's a lot of variables and a lot of factors to take into consideration, but don't let that overwhelm you, because once you start with the basics, you're going to be able to figure it out and you're going to get your feet wet and it's all going to feel more comfortable. And the other thing to keep in mind too is if you're already a trader, if you trade commons, just the ability to read a chart, to understand your levels, to understand risk management, scaling in, scaling out, however you handle your stop losses, so much of that transfers over to options. So there's a lot of stuff that's a little bit intimidating about options at first in terms of the terminology and how things move. But if you have a strong foundation in terms of how you take your entries, how you take your exits when you play commons and all the risk management involved, all of that is super, super applicable here, and it's going to give you a leg up.
Right. And there's one more misconception or things which a lot of like beginners can, like make a mistake, and it's a genuine one, is when you're transitioning from stock market, right? And let's say you have stop losses in place. Most people, like will assume that if the stock price comes back to the same level, for example, it's a break even, right? And they will put a stop loss there because they won't lose money, But with options, even if the stock price goes back to the same level, it doesn't necessarily have to go back. For example, stock was $100 and you bought 102 call, and even if the stock comes back and it went to 102, you didn't take profit, comes back to 101. Hey, guess what? Your option premiums will be lower than what they were earlier, because there are other Greeks which which have a role in the option premium price. So if you put break even stop, just know that with stock doesn't necessarily correlate 100%. The stock price doesn't correlate 100% with the option premium price.
Mm-hmm. Yeah, theta, which we will dive into more later, you will get to know theta very well in terms of the options Greek once you see the play move and you're like, wait, why is the underlying going up, but my stock isn't moving that much? Or why are we back to where I started, but my options contract is worth less now? So theta is a term that you will become very, very, very familiar with. And it's an important one. It's also why we like to mention buying time. But yeah, I mean, I think that as long as you have a basic concept and foundation here, Drippy and I will be diving into more of the specific terms and how those can affect your premiums. But my biggest suggestion with options would be, do not try them because you're overwhelmed with all of this. I know for me, one of the best ways that I learned was sort of just getting started with what I would call, I don't care money. That, or you can paper trade if that works for you. But just, to get an idea of how premiums move and how that varies from trading commons, because that's one of the biggest learning curves is, you're trading commons and the stock moves 2%. Okay, you gain 2%. That's great. In options, a 2% move can show up drastically in how it affects the price of your contract. So getting a feel for how these things move is a really big part of becoming acquainted with options.
Yes, and we'll help you folks with that. And with that said, some of the resources which you can look for is on YouTube. There are so many options related content, and there's so many great folks. I can list them, and one of them I hope is like my account. If I have YouTube content there, you can listen to it, and I plan to upload a lot of things in the future. And another thing is you can, follow me and Swing Pony on FinTwit, and there's so many other traders. I learned a lot from FinTwit, which is basically Twitter financial side of the Twitter. And last but not the least, if you want to have a little bit of more closer experience learning about options, and if you're interested in learning from me and Swing Pony, we'll share a Google form link in the description of this podcast, on Twitter, and other sources where we communicate with folks. And just fill out that form. It's a basic, very simple form. And like, if you need, all we need is the email address, and then we'll reach out to you in the future once we decide to do it. But yeah, if you're interested, let us know.
Yeah, we'd love to do a little workshop and just build out, the basic building blocks, all the stuff that as soon as you learn it, you're like, there's like a sense of relief and a sense of, oh, it's not as scary and unfamiliar and overwhelming as I thought. Like when I first started options, I did it all by trial and error. And, like I could have saved myself a little bit of money and a little bit of mental capital by, going to actual mentors and people who could help me understand through analogies and just setting out the basic foundations. But I love options. I wouldn't trade a thing about it. And if you are interested in trading them, we hope that this podcast, taught you a little bit, and just know that we have a lot more to talk about.
Yep. And this is straight into options.
Yep, this is straight into options, and we will see you guys next week, and we will dive into so much more about both, the technical aspects of trading, but also a lot of different psychological topics and just everything that we experience as traders from day to day. So thanks for tuning in, and we will see you guys next time.
Ciao.